Hi, everybody. Simon Singer here. Thanks for taking the time out of your probably incredibly busy day because we have people just lined up outside our office just waiting to get in to see if they can get some free stuff. Our guest today is going to be a young man that I met at the Forum 400 meeting. Despite the fact that he looks like he's 12 years old, he's not. He's married, he's got a family, and he's become a very high-level specialist in both estate planning. But what he's going to talk to us about today is the whole market of senior settlements and some of the flaws that the general market has and the process that he's created in order to overcome those flaws, help get more money to our clients. And in this, folks are looking for extra money and their insurance policy might be a place to go. And so Daniel's going to speak to us for about a half hour to 45 minutes. We'll have questions at the end. And then if you'll hang on, we want to talk to you about the successes that we've been having with our tax reduction plans for small business. So at this time, out of Houston, Texas, Daniel Zeppelin. Daniel, would you please?
Sure. Thank you, Simon. Hope everyone is staying safe and staying healthy. So I'm going to talk about something today that is an actionable item for everybody on this call. And given the current economic environment and circumstances, I think you're trying to find different streams of revenue, different ways to add value to your clients. This is certainly an opportunity, and I'll talk about the impact of COVID-19 on this marketplace. Do I have full control over the slides now, by the way?
I think you do.
I don't know how. Okay, perfect. Okay, so brief history, just to be very candid. My first and foremost focus is selling new life insurance. I've been in the business for almost 12 years now. I own a brokerage general agency in Houston, Texas, and our focus has always been selling new life insurance. We always historically, life settlements have always kind of been this taboo word in our industry, and had never been our focus. We worked with every settlement broker out there, Welcome Funds, Asher, Life Insurance Settlements Inc. We've gone direct to Coventry. We've gone direct to Abacus. They'd always come in and say, we can make it easy. But every time we would do it, and usually historically we'd probably do somewhere between 1 to 3 cases a year. And it was always when a client came to us and said, hey, I want to sell this. You need to figure out how to make this happen. It was always a frustrating experience. There was a lack of transparency, and we never really felt like we knew what was going on. From start to finish, the process could take up to 6 months. Took a lot of our time and energy when our broker was supposed to be doing all the work. And the fees were astronomical. The typical fee associated with the transaction is generally 30% of the sales price. So, for example, if you sell a policy for $1 million, $300,000 in fees is paid to the broker. So, in looking at this, we figured really what happened is towards the end of 2018, we had several cases that came up, and we got to the point where we were hitting our head up against the wall and so frustrated with the traditional process that we figured there had to be a better way. So we decided we were going to just start doing it ourselves. Trying to get to, there we go. So the opportunity, this market has changed quite a bit over the years. And when I mentioned 2018, the Trump tax plan made this a much more attractive option for sellers. Essentially what happened is with the Trump tax plan, not only did it make more inventory available, where you've got a lot of individuals who had purchased life insurance, maybe when the exemption may have been $1 million. Well, now with the increased estate tax exemption, there was a lot of unneeded life insurance in the marketplace. And on top of that, the sale of the policy was taxed in a more efficient manner. Generally speaking, the sale above and beyond your cost basis in the contract was taxed at long-term capital gains. But pre-2018, the way you would calculate that basis was different than where it is today. It used to be you'd have to, if you had a $1 million basis in the contract, you would have to, under old tax laws, you'd have to solve for your cumulative cost of insurance, which could all but offset your entire basis. What the Trump tax plan came in and said was your basis is your basis, and there's no offset from the cumulative cost of insurance. Additionally, there's a lot of capital and a lot of buyers in this marketplace looking for an uncorrelated asset class. And in light of recent events, all that has happened with what is going on with pretty much every other industry and current market conditions, this has only firmed up this asset class because, again, it is uncorrelated to everything else. And with that, there's more competition in the space, buyers now targeting lower returns. So essentially, pre-2018, you had a lot of funds that were targeting returns. Again, this is based off premiums projected to carry the policies to maturity and the overall health of the insured and their life expectancy. But the IRR that the funds were looking to generate at life expectancy was generally somewhere between 22 to 24% at life expectancy. What has happened is because you have so many more buyers in this marketplace, you're now seeing transactions close closer to 12 to 13% IRR at life expectancy. And then you've got this tremendous pipeline of policies where you've got policies that were initially sold, funded to what was considered life expectancy 20 years ago, maybe 80, 85, 90 policies aggressively illustrated that have underperformed and have been underfunded. So it's very often where you'll see a situation where you have an individual who's had a life insurance policy for 20 years. They've been paying, $15,000 a year, and then all of a sudden, the premium increases to $250,000 if they want to maintain it. And then when we looked at all of this, kind of this perfect storm of opportunity, we then said, okay, well, there's a need for disintermediation because generally speaking, there's so many different layers in the transaction that at the end of the day, it minimizes the amount that the client nets when the transaction is closed. So if there was a more efficient way to do it, we felt we could add significant value to our clients. And then lastly, talking about the impact of COVID-19, if anyone on this call has watched any major network, it doesn't even have to be a news network. It could be ESPN. It could be, I know Fox News, CNN, they have it going on routinely, but any major network out there, you cannot turn on the TV and not see a commercial right now for Coventry Direct. They are marketing aggressively right now, knowing that people are looking for liquidity. And the fact of the matter is most individuals do not know that this is even an option. I know there's a lot of agents, life insurance agents that have been in the business for years who aren't even very familiar with this outlet. So I know, again, just looking at my own business, and I'm sure it's probably similar for a lot of the people on this call, our new life sales since the quarantine and everything that's going on as far as it's very difficult to get people examined. When they're under quarantine, our new life sales have dropped significantly, but our settlements have gone through the roof. We're getting, probably 25, 30 calls a day on settlement opportunities. And a lot of that is people are looking for liquidity, and this is a viable option, especially if the coverage is no longer needed.
Daniel, can I interrupt you for a second? You're getting
Absolutely.
You're getting 25 to 30 calls a day. Are you getting
Yes.
those calls on relationships that you have established with CPAs, attorneys, or are you getting them from clients direct? Where's that activity coming from?
All of the above. So we've got direct client relationships, CPAs, estate attorneys we work closely with, other insurance agents that we work closely with, guys from the Forum 400, other wholesalers that do what we do. So literally above and beyond every center of influence with regards to life insurance, we're getting calls from.
So for the people on the call, you've got clients, you've got prospects, you've got professional advisors that you're either working with or you were trying to work with, and they've got people that are calling them, trying to cut back on their rent payments, trying to cut back on their employee payments. Basically, what it says is they don't have enough money. So this potentially is a way to help them raise some money with a wasting asset at this point. It may not be a wasting asset in January 1st of 2026, but right now it is. Is that right?
Correct. So you're essentially finding liquidity, in a lot of people's minds, monetizing what they view as a bad asset.
Okay. Thanks.
How do I go back? I accidentally skipped over a slide.
I would imagine you hit the up arrow.
There we go. Perfect. We're there. Okay. So just our process. The way we run our process, the most important part of the entire settlement transaction is managing expectations and pre-pricing the contract. So where I mentioned, we're getting 25 to 30 phone calls, naturally, 25 to 30 phone calls don't immediately turn into viable opportunities. But there are questions you can ask immediately, calculations you can run very quickly to at least get a general idea as to whether a contract will be attractive or not. Generally speaking, when we start the process, we're going to request the necessary in-force illustrations. What I never understood is when we were working with brokers, they would always say, give us an illustration, a minimum level premium to guarantee or carry the policy to maturity. That's fine as a starting point. But again, there's a difference between settlement brokers and life insurance guys who understand life insurance and understand settlements. So generally speaking, if you've got a situation where you have an 83-year-old with a 6-year life expectancy, why would you order an in-force illustration that's going to be where you're paying the premium to carry it to age 100 or to age 120? It doesn't make sense. What you want to do is you want to give the funds the tools to extrapolate every last dollar of value from that contract. So, for example, in the situation I just gave, we would suggest maybe a illustration to carry to age 89 with the catch-up premium. Again, giving them the tools to extrapolate, the highest IRR that they can. We then have the client complete our settlement applications. It's a 5-page application that's really just a matter of signatures that give us the proper authorizations we need to shop the file and compile medical records. Then once we compile all the medical records, the beauty of this process is, especially in a time like right now, as I mentioned earlier, it's very difficult to get clients examined. And there's a lot of carriers that have now come out with streamlined underwriting processes. They used to be generally up to $1 million. I think now there's some that'll go to 3 or 5 million and some higher. But with this process, no exam is required. It's simply compiling the medical records, and that gives us what we need to order life expectancy reports. And what I found is when we were dealing with the brokers, I found a lot of situations on cases that we had shopped where no life expectancy reports were actually ordered. And the reason they would do this is because life expectancy reports are expensive. If you're building a case properly, you can spend upwards of $5,000 to $10,000 alone just on life expectancy reports and getting the correct analysis and evaluations. And similar to life insurance, for example, where there's certain carriers that are more aggressive with cancer history or tobacco use, the exact same thing on the life settlement side, but where on the life insurance side, you're trying to paint as good a picture as possible. On the life settlement side, you're trying to paint as bleak a picture as possible. So when I say there are some life expectancy providers that are better than others, for example, with dementia, they're going to be, they could get the exact same information and one life expectancy could come in half as long as another one. It's just a matter of knowing who to go to and actually ordering all of the life expectancies that are needed. When we shop our case, we send this case out to market. We send it to every licensed buyer in that specific state. The state is going to regulate who can buy and who can bid in that specific state. And the way we shop our case, what always used to drive me crazy is when I talked to settlement brokers, they'd always come to me and say, well, how much do you need to sell it? And my question was always, well, I don't know, how much is it worth? Well, the only way to know how much a policy is truly worth or any asset is the market's going to dictate the value, and that's the same thing here. So essentially, the way we run our process is we take a case out to market, we send it to every licensed buyer in the state, and we run an auction. And at the end of the day, the highest bid is going to win the policy. It's fully transparent. We focus on transparency both on the seller side, but then also on the buyer side. There's no games being played. And essentially, when we build the case, we send it out to market. We give every buyer about a week and a half, 2 weeks to do their internal due diligence. A lot of the buyers now also will run their own internal life expectancies. But once that's done, after about a period of a week and a half, 2 weeks, we set what we call our 48-hour auction deadline. And whatever we'll receive bids during that 2 week process, but whatever the high bid is at the end of those 2 weeks, that's what we announce to the marketplace. And we give everyone 48 hours to increase that bid. If we get an increased bid in 48 hours, we then extend the auction an additional 24 hours to see if we get a higher bid. And we will continue doing this process until there are no longer any additional bids. So it gives everybody time to see exactly what our number is. There's no one's coming in and stealing a policy when someone's not paying attention. Everyone is aware of where we are. And the way at the end of the auction, we've seen what always used to drive me crazy is when we go and we close on a contract, I'd always ask our broker, well, are we sure this is the highest number? And the response I would get oftentimes were, well, don't worry, I always ask for another $40,000 at closing. I don't know what that means. How do you not know you got the best and highest value? So in this situation, when our auction starts getting to the end, you start seeing increases where they start at maybe $50,000 increases, then it's $20,000, $10,000, $5,000, and on the smaller face amounts, we'll see $1,000 increases at the end. And that's how you know that you're getting every last dollar of value. When you talk to your client, you can tell them definitively and look them in the eye and let them know that we got every last dollar that was out there. We didn't leave anything on the table. And I think that's, yes.
Let me interrupt you for a second.
Sure.
All of the settlement brokers basically say the same thing that you've just said. They talk about the same thing with regard to the process, the pricing, the pre-pricing, and the in-force illustrations, et cetera, et cetera. You are correct when you said the thing that used to drive you crazy was, and you listed off a whole litany of things because you never really knew what was going on. How can our members tell one from the other? In other words, are you saying that every bid that comes across the table gets thrown up on the screen and they get to see them all? Because usually, okay, so that's a major difference because everything basically was being hidden. They would tell you what they had, but you never really saw it. Is that right?
Correct. So what I found is, at least from my experience and from other individuals I've spoken with who had similar experiences, it was always this black box. They said they were shopping it, and sometimes they'd give you an idea of where you were, but they wouldn't tell you who the buyer was, and they wouldn't tell you where the increases were, and they wouldn't share the life expectancies with you. Now, because we order the life expectancies, we won't send out the life expectancies just because we don't want someone taking what you paid for and shopping it, going to somebody else and shopping it. But we'll certainly be very transparent on where the life expectancy was. But what we do is we like to engage the client in the process and let them know. We're very upfront with our fees. The last line in the slide is showing that our fees on average are 33% less than the rest of the marketplace. But we're very upfront with our process, our fees, how it works, what we're doing. And when you engage the client, you engage the advisor in the process, and they see the growth, and we'll get to this in a second when I start speaking on actual case studies, they see the value that you're providing. And what always used to drive me crazy when you go to closing, because a lot of the states are full disclosure states. So commission is fully disclosed. The client knows exactly how much you're making. And but what I never understood, and this is referring to as specifically in Texas, when we would go to closing, the broker would always say, "Oh, well, don't worry, you just have the client sign. You kind of skip over that page." Well, that didn't make sense to me. And it was always kind of sticker shock when they look at what the fees are, and nothing's been previously communicated. So we're very upfront with our fees. We're very upfront with the process. and we inform as we go through the process. We give the client a call at the end of every day. We tell them the growth. We tell them, the increases we received, and let them know where we ended at the end of the day. And it's generally speaking, when you're seeing growth of $200,000 a day, or so on and so forth, the client is eager to pick up your phone call at the end of the day, because they want to see what happened, and they understand the value that you're providing. And I'll get more to that with our next slide. Does that address your question? Yes.
Yeah, let me cut in on you a little bit too. I think the first time I saw you speak, I remember coming up to you saying that is the first time I've ever heard an explanation that would allow me to look my client in the eye and say, yeah, you got the best deal on the market. And I've never heard that. That was amazing to me, because that's the reason I always was so uncomfortable with these transactions. Because, I get quoted a number from Coventry or whoever, it doesn't matter who it is, and they tell me it's best, and I have no way of knowing that it's best.
Right.
This is beautiful. I mean, this is a reason why you're here with our group.
Well, Brad,
and
sometimes the company that you just mentioned is actually bidding for their own account, and you wouldn't know.
That's exactly right. Yeah, this is very nice. The transparency is amazing.
And what you'll find too is when the case is quote unquote being shopped, even by a broker, they may only take it to their 3 favorite buyers, and they are shopping it. They are running maybe an auction equivalent, but it's only going to 3 buyers. So you really need, because you never know. I mean, we've done we've closed cases with so many different buyers, because again, they might surprise you. One that's not competitive with a certain impairment, maybe more competitive with another impairment. They may like a different carrier better, or a different product type. But again, that's why you have to shop. And then what you find is that there are certain buyers that refuse to work with certain brokers, just based on past history of issues and so on and so forth. So again, our process, fully transparent. We're an open book. There's no secret black box. So next, I'm going to talk about actual case studies, actual cases we've done in the last. This first one's within the last 18 months, but generally speaking, it's within the last 12 months. Here we go. So this is an actual auction. This was, I always refer to this as our proof of concept case, when we thought we were really onto something. So we had an individual, John, age 83. This was a case out of Rockville, Maryland. $19 million of coverage, paying an annual premium of slightly over $1 million to guarantee coverage to age 100. His life expectancy was about 8.5 years. Essentially, his wife had passed away. They had done some estate planning techniques where the insurance was not as important as it previously was. He decided he no longer wanted the coverage, was going to surrender it for the cash value, and then we thought we could sell this. This policy was shopped 2 years prior to us taking it to market through one of the top brokers in the industry, and the top offer received was $1.33 million, with health being about the same, just he was a couple years older. Our opening bid when we took this to auction was from Coventry, again, talking about the Coventry commercials that you routinely see. And the opening bid was $1.5 million to start the auction. When we closed the auction, we closed at $6.5 million. So that gives you an idea of the growth. And again, if you look at it from logically, when these policies are taken to market, or when you go and you're engaging with a buyer, the buyer's fiduciary responsibility is to their LPs and to their fund. They're trying to buy this for as little money as they can. So the seller really has no advocate, even though the buyer may act like they're, in favor of the seller getting as much money as possible. They're not. They're trying to, buy it for as little as they can. Well, in this situation, if you have a true advocate for the consumer, that's representation that if they go about it themselves, that they're literally, flying blind and don't know what they don't know. And in this situation, had the client, he was ecstatic with 1.5 million because he didn't think it had any value. So that's why Coventry is kind of the gorilla in the room, not because they can be super competitive, but they spend $26 million a year in marketing. So they get a lot of looks at contracts where there is no competition. And when there's no competition, they basically get to name their number, even though the policy may have significantly more value than what is initially being offered. Go to the second slide. Here's another example. So there's all different types of policies that can be sold. This was actually an individual who was a financial advisor and worked in one of the wirehouses, was about to retire, had $4.5 million of term coverage. This was a case that was brought to me after I presented at the Forum 400. And the individual came up and said, look, I'm having all the same issues that you mentioned. We've got a $1.5 million term policy with SBLI. Conversion premium is about $100,000 a year. We have a $3 million term with MetLife. Conversion premium is about $200,000 a year. We're using a broker. We're going to Coventry. We're going to Abacus. They told us the best number we're going to get is $280,000 for the SBLI policy, and that the MetLife policy has no value. So he started explaining everything to me, and it didn't sound right to me. It didn't sound like it had really been shopped or vetted. So we built the case. We ended up, we closed the SBLI policy at $500,000, and we were able to sell the $3 million MetLife policy for $445,000. And then on top, so the agent was ecstatic, the client was ecstatic, and the agent also made full commission on both term conversions. So the term conversions are amazing when they work. When you're looking at selling term policies, there are a couple different things at play. Obviously, it's the healthy insured. This individual was impaired. You see the 11.5-year life expectancy, but you also need it to be convertible to an attractive or semi-attractive policy. There's a lot of carriers now that limit who you can convert to. That's the reason on the MetLife policy, it was only convertible to a MetLife whole life. So that's why we got less for the $3 million death benefit than we did for the 1.5. But when those situations arise, it's rather than letting clients just let your term policies lapse, which is what this individual was going to do, we were able to create significant value.
Daniel, I had the president of one of the major companies say, well, of course we don't make every product that we have in our portfolio available. We don't really want them to buy it. Basically what they were saying, buy it. We don't want to buy a death benefit for ourselves. And they knew full well that the only people that were converting were the people who couldn't go out and shop and get a better product. So he was very clear that we have no interest really in them going to our better products in our portfolio.
It's that adverse selection. I mean, that's and you see it and I think that on the front end, right, there's more value associated, even though, term insurance is so commoditized now where everyone's just looking for the cheapest term premium. You certainly need to factor in conversion privileges and options and what's contractually guaranteed and contractually obligated and stuff like that. I mean, we certainly do when we're recommending term policies today. Here's another situation. So there's a lot of thought that you can only sell policies on people that are 1 foot out of the grave, or people that are terminally ill. And that's simply not the case. And I'll give you an example here. We had a situation, we had an individual, 78 years old, he had a $1.5 million UL policy with Voya. Annual premium was $28,000 to carry the coverage to age 90. He had about $40,000 of cash surrender value. Given that Voya was no longer in the life insurance business, there was a lot of carrier concern from his standpoint, and it was a non-guaranteed contract. Insured was in great health, had no impairments. We actually got him approved with Lincoln Financial at a preferred risk class. So essentially what we were going to do is we were going to surrender the Voya policy, use the $40,000 and help offset his $45,000 premium with Lincoln. What we were able to do is we sold this policy to what we basically refer to as a healthy fund. And instead of surrendering it for $40,000, we were able to net the client $235,000. And he was ecstatic. Basically, the way the healthy fund works is they don't care if the insured is impaired or not. They price the policy the same way. When they buy a policy, they immediately buy an annuity on the life of the insured. So they don't care if the insured lives too long, dies too soon. They're basically trying to guarantee a rate of return of like 6 or 7%. It just depends on the situation. But again, it's viable if you've got an efficiently priced policy. Even if the carrier is not great or the guarantees aren't great, there's a market for it. And in this situation, we were already going to put them in a more secure product, and this just helped offset the premium burden on an individual, again, who's in his late 70s and had no impairment. Another situation where we were able to buy new coverage. We had an 86-year-old, $5 million underperforming DUL. Ellie was very healthy, 86-year-old. The Ellie took her to basically 97 years old. When we started our auction, our opening bid was $110,000. When we closed it, the closing bid was $900,000. But the advisor was able to sell her move her into a more secure product, got her approved at a standard risk class with New York Life, and generated a $250,000 fee on the new sale. So again, it's just finding liquidity, taking something that people view as either a bad asset or in some instances even a liability, and shifting it elsewhere, reallocating those premium dollars. This goes back to some of the laziness that's in the marketplace. This is another individual who I met through the forum, and they had taken this to a broker before they took it to us, and the broker basically came back and said, look, you're not going to be able to sell this policy. It has no value. Just surrender the policy for the cash value. So it was a second to die policy with Transamerica, $5 million of GUL coverage. Annual premium was about $70,000 a year. Ellie, on a second to die, generally speaking, they're going to base the mortality and the life expectancy on the healthier insured. So you've got essentially a 12-year life expectancy. Client didn't want the coverage anymore. They were just going to surrender the policy. They had $750,000 of cash surrender value. And again, the previous broker said, look, you're not going to get more than that. Just surrender it. So I came back to the advisor and said, look, if we're going to take this case to market, we have to manage the expectations. The client thinks they're going to sell this policy for $4 million. That's not realistic, and that's not likely. So we talked to the client, explained the process. He said, look, if I can get, $50,000 over my cash surrender value, I think that's meaningful, and I would sell it for that. So when we find and figure out what the client expectations are, that doesn't mean we stop the auction once we hit those expectations. We just want to set something that's realistic, and hopefully we under promise and over deliver. So in this situation, our opening bid was $900,000. So we immediately were already above the cash surrender value. And when we closed the bidding, we closed at $1.36 million. Client was ecstatic. Agent was ecstatic. And it just goes to show, I'm very aggressive when I think a case could price, especially in an aggressive marketplace. More times than not, I'm going to take the case to market. But there's just a lot of laziness in this marketplace. And with this situation, because there was a $750,000 of cash, we were able to manipulate the illustration, showing like a skip premium design and various catch-up designs, and using some premium optimization designs associated with GUL contracts to make it to show more value and make it more attractive to buyers.
So Daniel, go back to that one for a second, would you please?
How do I go back?
Just hit the back arrow. I love the way it sounds like I know what I'm talking about. You've got opening bid $900,000. You got closing officer $1,360,000. You said the client was excited. I can understand why. He got $400,000 more than he was anticipating, and $400,000 more than he was willing to settle for. And the agent was ecstatic. Why was the agent ecstatic? You said earlier that your fees are about a third less than the market. Can you speak a little to that, what that means?
Sure. So our fee in this situation, our fee just to run the auction process is 14%. And in this situation, we took our fee of 14%. The advisor quoted a fee of 10%. So he basically made $136,000 on the sale of this policy. And the way we always explain to the client is again, our fees are disclosed up front. They're disclosed during the contract process. But it's always don't focus on our number, what we're making. Focus on your net number. And so he was ecstatic. He netted over $1 million on a policy they were about to surrender for $750,000. Created a commissionable event for the advisor, and again, this was a referral to the advisor from a CPA. So in the CPA's eyes, this advisor was a miracle worker, and we always like favorable and positive outcomes, and this, of course, was one of them.
So then what would have, let's take the elephant in the room. What would the major company in this industry have charged in that environment?
Minimum of 30%, and in a full disclosure type situation, you can actually charge north of 30%. So I would say your minimum average market fee is 30%, but it can be more. And in a disclosure type situation, as long as the commission is disclosed and the client signs off on it, you can essentially charge whatever you want.
Really? So
Yep.
So you're saying there would have been about a $400,000 fee, and now was his 10% in addition to your 14?
Correct.
Okay, so you were charging, I'm going to round the number, 25%. So it was about $350,000 as opposed to $500,000. So the client, well, I mean, the only place that's going to come from is going to come from the client's offer. What does an agent have to do with regard to his E&O insurance or his broker dealer or things of that nature? What has to happen?
So different broker dealers are different. So I can't speak. I can't give a generalization there. But in order to participate in a live settlement transaction, from a commission standpoint, the agent has to be licensed, has to have a live settlement license to receive compensation. And generally speaking, to get the live settlement license, you also have to be life licensed. A lot of states, it's a matter of just filling out a form. Some states, specifically California, New York, Texas, can be difficult, but there are more steps involved in the process. But most states, it's really a matter of paying a fee for the license, and it can be done in a matter of days.
And so some broker dealers are going to say you can't do it, I would assume. Some broker dealers
Correct.
are going to say you have to run it through us. And some broker dealers say you can treat it as an outside business activity, I would imagine.
Correct.
Interesting. How many buyers are there in the state of Texas?
In Texas, there's, I think, like 21 or 22. Naturally, though, where you've got these buyers, really, I would say probably 12 or 13 are usually competitive. Every once in a while, there will be one that really likes a risk, but you usually see the same 12 to 13 that are that get aggressive. Because what you have to understand is, even though, and we still, even the groups that aren't competitive or never bid aggressively bid, we still send the case, because it's really important when you're communicating this to the center of influence and the referring source or the advisor, that you can say that we did go fully to market and every buyer had the ability to look at this case. But a lot of these funds are trying to, again, they don't want to, they're not as big. For example, one of the biggest funds in the space is a group called Magna. And last year they spent almost $1 billion buying life insurance policies. And the year before, I think they were right at 900 million. So they're spending a lot of capital. So it's very difficult for a fund that may only have, $20 million or $30 million to compete with a fund like that. And generally speaking, if they're trying to buy these as cheaply as they can. So you've got a lot of the smaller buyers that, again, simply just can't compete with the auction process. But we still send it to everybody, because we want to vet the entire marketplace.
So that's pretty expensive then, doing the illustration, getting all the attending physician statements, doing the life expectancy analysis, then trying to figure out what the rate of return is that the buyer is looking for, which I'm sure they're not telling you, but you've got enough experience where you can probably approximate that. You can see whether or
Sure.
not you're getting, you can see whether or not you're getting close, I would imagine.
Yes, that's why the pre-pricing part is so important, and we can do that. Obviously, there's some level of there's that element of that unknown variable because you really don't know the health of the insured until you get the medical records. And as we've seen, you know, even the best life insurance agents, they're not great doctors, and they're not great assessors of health. And we've had situations where someone's told us, oh, this guy, you know, he's in terrible shape, and they have a 20-year life expectancy. And then we've had other situations where we've had people say, no, there's really nothing wrong with them, and there's a lot going on. So we try to do as best we can off of without a doubt, to price the policy. Now, term policies are different, but we always try to get the in-force illustration, or at least in a term situation, the conversion illustration, to really give an idea of where it is. I'll tell people, we looked at one yesterday where the advisor wanted me to give him a number to talk to the client. He said he had a $2 million UL policy with Guardian, could only quote me the monthly cost of insurance, and that was it. And I told him, look, I can't do it. I can just make up a number, but that's all it would be, is just a made up number, because we don't want to, if we're going to stand by it and manage the expectations, we need the tools to do it correctly and appropriately. And part of the reason, I didn't mention this earlier, but part of the reason I think we have so much success with our auction is we've had one situation in all the auctions we've done where we have not closed the contract. And the closing process is there's a lot involved. We try to make it as simple as we can, but a lot of brokers will take a case to market. They haven't even discussed selling the policy with the client. They just will tell them, hey, we're looking at some other options, and they just tell them the final number at the end. We try to pre-vet the client, the opportunity, as much as we can, because just like on the life side, if you send 100 informal applications to a carrier and you don't place one case, they're probably going to start taking your applications not very seriously. Well, it's the same on the settlement side. If you send, because it's costly for them too to do their own internal, due diligence and everything that's associated with that. They don't want to bid and sharpen the pencil and get every last dollar and then have an individual never close on a case. So in the one situation we didn't close, it was a 92-year-old who had a heart attack as we were going through the closing process. So we had strongly advised it was not in his best interest to sell the contract, and he eventually agreed. But that's important, and that's, again, goes back to the transparency both with the buyers and the sellers. And what I found very interesting when we started doing this is when we talked to the buyers, they were so fed up with a lot of the traditional brokers and the games that they were playing. Because again, if done properly, it's a viable option for your client. But a lot of the brokers in the space have started playing all these different games to try to justify their value, and it's really created this greasy, distasteful industry where again, it's just it's a transaction, it's an asset, and it's just a way to find additional liquidity.
Well, what I found interesting many years ago, about when it was explained to me that they're already selling the policy, if they're going to let it lapse, they're selling surrender value back to the insurance company. And
Sure.
there was the broker dealer I was at actually insisted that we had to take it to market, that it was not in the best interest of the client to just let them do that without letting them know that there was an alternative buyer out there besides the insurance company, which we were pleased with. So the opportunity comes from where? Existing referral sources? What are you seeing?
All of the above. So we've gone extensively through our current books of business. I found a lot of opportunity. Any center of influence that has some tie to life insurance, and again, whether it's wealth managers, advisors, CPAs, estate attorneys, insurance agents, other wholesalers that do what I do, I try to tell the story to as many people as I can. And again, we've all experienced similar frustrations. We created this process not because we thought, hey, we're going to create this new settlement company. It was more we found a need, we had an issue, and we solved the problem for us. And that was initially we created this platform for our own clients. And then, over the years, it's kind of turned into a big business on its own. But again, you're solving for a need, and I've used it as a differentiator because it gives me something different to talk to these centers of influence about that most people are not talking to them about. And I'll give you another example. And I've got one last case study that I think is really important to get to after this. But we had another example on an individual. He was probably one of the top insurance agents in Houston for 40 years. He was in his 70s. And we talked to him about it, thinking that he had a lot of contacts and give him something to talk about. He said, well, wait a second. I got $1 million policy on myself. I was just going to let it go. You think there's any value there? Again, this is a guy who's been in the business for 40 years. And he did have impairment, but we sold his policy for $540,000. It was $1 million VUL with a $100,000 loan on it. So, but it goes to show just the lack of knowledge. A lot of people, even individuals who've been in the space for tens of years, just have on this topic. And it's always kind of been, again, this taboo topic in the industry that people have always kind of stayed away from. But now it's like I said earlier, with the opportunity and everything that's going on in the marketplace, you're getting some really, really aggressive valuations on a lot of these contracts, where even if you can afford to pay the premium, it's just a calculation, and it doesn't always make sense. And then on top of that, if you have people that can't afford to pay the premium and they're going to let the coverage lapse, this is just simply a better way to do it.
Interesting. Todd, Bobby, have you got the ability to open up the, you might already have questions there. If you do, can you share them with us?
Yes. We only had one question at this point that I can see, and it just says transaction. And I don't know what that means. So let me open. If you have a question, please raise your hand. And what we'll do is we'll unmute you. You'd ask your question.
I do have some of the questions I can jump in with.
Thank you.
The reason I jumped off is my battery on my laptop died, so I'm going to go off memory here. One of the questions was, does each state, I know you addressed it a little bit, Daniel, but does each state require, are there some states that don't require licensing?
Yes. So for example, like the state of Michigan, Michigan is unregulated. So there's no licensing required there. And there's a handful of others, but most states do require some form of licensing.
Okay. And you could just check on your individual state's regulatory website, I would assume.
Yeah, or, just call me or we've got a list of all the states.
Okay. I have, I'm going, these questions I'm going off memory. I did reply to some of them online that are already answered, but one of the other questions came up is, what do the companies that purchase these policies, who generally, are they keeping them in their portfolios? Are there other insurance companies? I mean, what's the makeup of the buyer?
A lot of it's institutional capital, pension funds, hedge funds, so on and so forth. So we've had the objection before. Well, hey, we don't want like the Gambini family, owning a policy on my life and trying to knock me off. That is not how this works. You're just simply a number. And there are going to be situations where you've got funds that will sell on the tertiary market to other funds. So a lot of these buyers, they know that when they buy a policy or when they get a life expectancy report, they know that there's going to be individuals that die too soon. There's going to be individuals that live too long. There's going to be individuals that die right on time. There will be situations where the fund just made a bad purchase, and the policies have gotten to a point where it no longer makes sense for the fund to continue to maintain the premium. So that happens as well. But generally speaking, you are dealing with large institutional capital, and Coventry, who again is a big buyer of policies. The misnomer with Coventry is that they're not using their money. They're representing multiple funds, and oftentimes Coventry will buy policies and then immediately sell them 30 days later on the tertiary market. So like Magna, one of the larger buyers in the space, they routinely buy policies from Coventry, just policies they never looked at or never got a chance to price. So it's pretty interesting, all the different pieces involved. But another piece on Coventry, their biggest financial source, I think up until like 2012, was AIG. So Coventry would buy policies. They wouldn't buy AIG policies, but it's interesting that where you've got a lot of insurance companies that frown on this type of thing, when you've got insurance companies are actually the ones buying these as well.
Well, I think the reason for that is that, strangely enough, insurance companies really aren't in the business of paying out death claims. And
Yep.
They know that if a policy that was going to be terminated, either by surrender or by lapse, is now likely going to be held until death because an investor owns them, and they have to change their whole pricing mechanism if enough of those are done, because now they have to take into account accelerated or more often a mortality claim is going to be made. And you see, to me, this whole process that you've put together, Daniel, it kind of fits right in, because we're looking for ways to create levels of differentiation. So this is a way of creating differentiation. It's a story that can be told relatively simply. It's not dissimilar to our story of the tax reduction plans that we're doing to be able to help small business increase their cash flow by reducing their taxes in a statutory way, even though they already have a CPA. CPA is not a specialist. We've got specialists basically around to help get in between the areas of the tax code and increase deductions, therefore reduce tax. This is not terribly dissimilar, being able to increase cash flow by eliminating premiums or producing what would have been cash surrender value and increasing that exponentially, so that people can maybe enjoy their life better, maybe buy a more efficient insurance policy, maybe do more assets under management. Who knows?
Right.
Next, are you noticing right now, one of the questions that came in from that Mark asked is this a slow period? Are you having trouble getting like APSs right now to get your LEs?
We're not. Now it's fluid, right? I mean, things are changing every day,
Right.
every week. But up until this point, it is not. What I have noticed, though, is that funds are making it easier to close. So, generally speaking, a notary is required when you do the closing contracts. You've got funds that are saying, hey, look, we don't need a notary, or they'll waive a lot of the carrier requirements that are typically required at closing. Again, because they're eager to deploy that capital, right now and get deals done. So, no, I mean, they're moving about the same as they always have. I think where we're seeing more interest in selling policies on the buying side, it's moving as it always has. And like I said, with regards to the marketing that's being done to generate interest and educate the consumer on this type of transaction. A lot of the marketing is being done right now, just people watching TV and seeing these commercials. So it's being done for you. So I would assume that most people, if you've been in the business for any period of time, you're getting calls from your clients or from your referral sources asking about these options.
Okay. I would assume. Go
Brad,
ahead.
let me jump in for a second because I just received something very interesting across the internet. This is decreases that people have noticed in the last month. This is coming via LinkedIn. Earned income or wages are down 28%. Personal savings are down 32%. Number of investments are down by 30%. Retirement account balances are down by 56%. Well, that could be the market reflection as well, not just people drawing down on the money. And personal spending has been reduced by 54%, and recurring debt payments have reduced by 12%. So that kind of says to me that people are looking for money any way, manner, shape, or form they can get it. We don't really know how long this COVID thing is going to go. The one thing I do know is I'm not terribly anxious to believe the newscasters or the government, because they're going to tell us whatever they want to tell us to be able to get to the next day. But the fact remains is it's an opportunity to help people with their lifestyles, their retirement accounts, whether it be senior settlements done on a transparent basis or reducing taxes, which is more of an ongoing thing. Brad, have you got contact information that you want to give out? I'm not sure if we have a slide for it or not.
Yeah, you can, the members know how to reach me. And let me get in just two more quick questions, and then we covered the whole list. Some of them I were able to answer, Daniel, without pulling you up on here. On average, I know this is a tough question, but how long does the process generally take from the introduction to the client to the bidding process to closing?
If everything is moving efficiently, you can get it done in say 45 days, 45 to 60 days. The parts that can take the longest throughout the process, number one, compiling the medical records. You know, some doctors will get us records in 24 hours, others can take a month. So that's kind of that unknown variable. Then the other part is the carrier. How long it takes to get the information you need from the carrier, change the owner and beneficiary. Again, some carriers can do it in a matter of a week, others can take 30 days. So it really just depends on the carrier.
Do you have any issues ever with beneficiaries that feel that they've been taken care of because those policies that they thought they were going to wind up being the beneficiary of has disappeared?
So depending on if the oftentimes policies that we do sell are owned in a trust. So you've got the trustee who has to sign off on the contracts to actually sell the policy. If you have a policy that's owned outright, so like for example, if you've got an insured who's the owner and his wife is the beneficiary, as part of the due diligence and the contracts to execute the transaction, the wife, being the beneficiary, has to sign off on the transaction.
Okay. We'll kind of end with this question. I think the ones we missed, we'll certainly reply back to the individuals. Are trust companies a pretty good place to prospect?
Absolutely. Absolutely.
Okay. Yeah, I kind of thought they knew the answer to that. Here's one last one. How is Arizona? Is that a pretty big market for you?
Yeah, there's no funky issues with Arizona. Really, the states that are kind of weird, it's California, New York State, and I think Ohio. California is only really on the licensing side, but once you're licensed, it's pretty standard. Florida is, I think in Florida there's only like 8 or 9 buyers, and the reason for that is to get a viatical buying license in the state of Florida. It costs like $250,000. So you really only see the bigger buyers licensed in that state.
Okay.
But Arizona is standard like the rest.
Excellent. Well, I think that covers our questions. Daniel, it's been fantastic having you with us to go through the details. You can reach through the center, go to the website, they can go to the member portal. We'll have Daniel's contact information back up there. As normal, I usually suggest that you call me because I know where to find them, and maybe help you get the information together so that you're efficient with your time as well as Daniel's. For those, we do have a few folks that were attending the event that aren't members yet. I can be reached at Brad, B-R-A-D, at YOURTSR.com, which stands
Brad,
for
you're-
Center for
Brad,
Tax Strategies.
Bradley, you're breaking in and out.
Why don't you give them my email address then?
I think it's brad@ctsr.com.
Yourctsr.com.
Never mind what I just said. It's brad at CTSR.com. No, that's
Thank
probably
you.
the reason I haven't been able to reach you by email.
Thanks again. We really appreciate it.
Yeah. Daniel, thank you, my friend.
Thank you for having
Talk
me.
to you soon.
Good seeing y'all. Everyone stay safe.
Take care.
Stay
Amen.
safe.